right, good morning, everyone, and welcome. It's 9 o'clock sharp. So, what we've got in store for you, well, firstly, let me introduce myself. My name is Schulze, and I'm head of tax at RSM South Africa. And as you all know by now, our finance minister, Enoch Godongwana, he made his third, believe it or not, budget speech presentation yesterday, and that's what we're going to spend the next half an hour unpacking and having a look at the highlights that came out of that. So let's start by going through some of the stats that came through in the material, and starting with, I suppose, the budget period, because our government's financial year runs from 1 April to 31 March. And that's the period that we are dealing with or are in currently. So as far as the projections that we are seeing in the budget material, the important ones are the actual projections through to the end of March this year. So 31 March 2024 are what we see revised projections. And then we've, of course, got the budget for the following year, which runs to 31 March 2025, and a couple of years forward. So looking at the revised projections for year end 31 March 2024, we see that those were budgeted for in last year's budget. So in Feb this time last year, the finance minister announced that he was hoping to collect tax revenues of 1.787 trillion rand. And that you see in front of you there. And what always happens in the medium-term policy statement in November, we see that figure revised. And in fact, at that point, we were quite pessimistic and thought we'd be further short of that projected revenue figure. But as it turns out, we're a little bit better off than we were in November. No thanks to the way SARS, well, thanks to the way SARS is in fact collecting taxes, and that we felt. The aggressive nature of collections certainly is quite something at the moment, but they're trying hard. And we see that revised shortfall figure coming in at 56 billion rand for the year. So we're short on target, and of course that puts pressure all around. So where has that shortfall arisen? And I'm sure, as you would expect, corporate income tax was the biggest contributor, and it fell short by 35 billion rand. And of course, that's a factor of South Africa being heavily reliant on commodities. The commodity price cycle is in a low. So if you look at our miners and some of our manufacturers around the commodity environment, we see their profits dramatically reduced. And in fact, miners, I think we were 50% down on tax revenue compared to last year. So big contributor there on the corporate income tax side. That the same thing, when you've got high interest rate, where you've got consumer spending down, and we've got a very poor economic growth that's been revised to 0.6% of GDP. So a very stagnant, poorly performing economy at the moment. And as a result, you'd expect that to be down. So that contributed to 26 billion rand of the shortfall. Personal income tax, interestingly enough, is better than projected. I think partly because our projections were fairly conservative coming out of COVID, but also because of the aggressive nature of SARS. I think that has contributed. So SARS are doing their job. And then fuel levy a little bit better, and the other taxes also fall short. So that's the picture as far as where we are on targeted collections. And then those targets are coming from the following areas. And by far the biggest component is personal income tax. And you see that now is projected to make up 37.6% of total tax collections. A little concerning for me because that certainly is probably the highest level that we've been at. And I suppose partly because of the poor performance of the other taxes, but certainly 37.6% in my view is too high. That contributes 26 odd percent, 445 billion, and then corporate income tax under pressure at 17.4% or 301 billion rand. And then you see the other taxes progressively, a smaller component of tax revenues. And yeah, that then makes up the position as far as the source of where our tax revenue comes from. Then moving on to this slide, which is actually quite, for me, I found quite interesting. And there were a couple of pearls that came out of yesterday's announcement. And the first one, which in fact gave me some modicum of relief, was the fact that we're budgeting for a deficit to 31 March 2024 of 331 billion rand. There you see it. So revenue collections, 1.7 trillion, expenditure, 2 trillion, deficit 331. What's included in that 331 is our interest expenditure. So if you take that out, which is 360 billion rand, we're in fact running a surplus prior to our interest servicing costs. So that shows that Treasury is fairly disciplined in terms of its budgeting process. It didn't have a lot of room to move, but that for me was positive. Deficit of 4.7% of GDP, certainly way too high. And the result of that is how we're going to fund that deficit together with our other obligations that we've taken on, the Eskom debt relief, and then our normal loan redemptions that are coming up every year. Loans mature, we've got to repay them. So you see that in this section of the slide here, where redemptions for the current year, we're looking at 146 billion. The Eskom debacle, 76 billion. So total borrowings required to deal with settlement of debt and fund that deficit, 553 billion rand. Where are we going to get it? Well, it's going to come from domestic debt, so short-term debt of 88, long-term debt of 328, foreign debt of 45, and thank goodness the ratio of local to foreign debt is what it is, because our foreign debt component is very low relative to local debt. And of course, with foreign debt comes currency risk, and that our exposure is fairly low. And then we've got our cash balances. So in essence, that's how our budget is going to be balanced for this year. And and then moving forward, we see that deficit is projected to drop. And this is where we see this little windfall that the Treasury stumbled on. And that's sitting with the Reserve Bank in a thing called the Gold and Foreign Exchange Contingency Reserve Account, the GFECRA. And that is sitting at about 500 billion rand at the moment. And as a result of our currency depreciation. So as the rand depreciates, so that account builds up, and vice versa when the opposite happens. So what Treasury are saying is that they believe that at least 150 billion of that should be available to repay our debt. And that was another positive for me, that the debate whether this is a good thing or a bad thing. I think just logically, as long as your risk is covered, I think replacing interest-bearing debt with non-interest-bearing or a non-interest-bearing instrument, I think is great, which is what this will be. And that settles some of our obligation over time. So, at the moment, our debt to GDP ratio is projected to peak at about 75 point something percent in 2 years' time, which for an emerging economy is outrageous. The benchmark to be affordable is around 60%. So we're on a slippery slope here, and the key is that debt to GDP level is reduced, and that filters through into our interest servicing costs, etc. So that's just an interesting snippet here as far as how we intend balancing our budget and bringing down our debt to GDP over time. Let's then move on and have a look at our tax rate changes, our tax changes that came through, and where government is going to fund some of this shortfall. And unfortunately, you and I have been hit. So personal income tax, we see absolutely no change to the tables. So there is no adjustment for bracket creep that's taken place. So between 24 and 25, we're going to be paying tax at exactly the same rate, notwithstanding that most of our salaries are going to be adjusted for inflation. So our salaries go up, we're going to pay more tax, and that's going to go directly to government. So we've been given no relief for inflation. So disappointing, but I must say, given the state of the economy, given where Treasury are positioned, I think that's the least of all evils that we could have expected out of this budget, and we're just going to have to deal with it. So rebates at the same time have been left unchanged. Primary rebate remains 17,235. Secondary rebate 9,444, and the tertiary rebate at 3,145. So what does that mean? That means that an individual will start paying tax if you're below age 65 at 95,750 Rand. So that is the threshold that you have to get to before you pay any tax. If you're aged 65 and over, 148,217, and 75 and over, 165,689. So no change as far as that position goes. The same story with our medical aid tax credits. 364 Rand a month for the principal member and first dependent, and then 246 Rand a month for all other dependents per dependent. CGT rate, inclusion rate 40% for individuals, the annual exclusion of 40,000 still applies. Interest exemption remains exactly the same. So your first 23,800 below 65 and 34,500 above 65. And then any of you that are like me, my brother-in-law has been promising to put in our solar panels for about the last 8 months, and we still don't have them. So I've threatened him with my tax credit if he doesn't come and put them on in the next couple of days. But unfortunately, we didn't see an extension to that incentive. So solar PV panels have got to be up and running and in use by 29 Feb 2024. So just be aware of that if any of you are in progress. Then moving on to our taxpayer base and where our taxes are collected in terms of income levels. And it's always interesting to see that, if you look at your taxpayers that are earning below the tax threshold, there are 6.8 odd million in the country. You've then got progressively fewer and fewer taxpayers earning more and more taxable income, to the point where your taxpayers that are earning above R1 million of taxable income make up about 480 odd thousand. And if you look at their contribution to the overall personal tax collection, it's about equal to the rest of the 13.5 million registered taxpayers. So, kind of as expected, I don't think that's anything new, but it does just put it into perspective as far as the number of taxpayers that are paying the majority of personal income tax. Then moving on to transfer duty, as has become the theme of the session, no change. So just a reminder here that when you buy a fixed property, if the fixed property is below 1.1 million rand, there is no transfer duty because this is a progressive scale, which you see here. And that progressively increases as the cost of the property increases 3%, 6%, 8%, 11%, and 13%. No change as far as that table goes, moving into 2025. Always interesting to see where our fuel levies go. And lo and behold, there's been no increase in the fuel levies this year. So small relief that's come through for us, and just interesting to see that that number sits at 6.18 Rand in total that we pay to government if we fill up a litre of petrol, and 6.06 Rand it's going to move to 1st of April odd when we fill up a litre of diesel. So around about 28% of the pump price. And I must say that diesel pump price is the wholesale price. So we certainly pay more than that. So we're probably closer to the 30% mark if you're driving a diesel vehicle. So some relief that's come through there at least. The only thing increased there are your carbon tax levies included in the fuel. And then always a bit of fun to go through the sin taxes, and those are the excise duties. And if you have a look here, this is the percentage increases on each of those line items. And we see the increases the lowest on cigarettes and the highest on tobacco. So on pipe tobacco and cigars. So that's quite interesting. And then if you have a look at your electronic devices, those are also in the mix now. And those have been increased in line with cigarettes. So let's just have let's have a look at a couple of the interesting ones. If you're a beer drinker, you're going to be paying 2.31 Rand, a 340 ml can to government. If you are a champagne drinker, 17.83 Rand a litre. If you're a spirits drinker, 88.49 Rand per 750 bottle. So that's quite a chunk that's coming out there, and so on. So that's the position, and those increases come through around about 1 April-ish. Let's then move on and have a look at our retirement reform program, and that's been in place for a very long time. And if we go back in history, what was aligned first in terms of this program were the contributions that are made to the fund. And Section 11 Cap F has been aligned across the board, no matter what retirement fund you own, and that is now unified. And our contributions and tax deductions in making contributions to our retirement funds are in place and don't change. What then changes is, at the same time, the second part of the program was to ensure that growth and income earned over the life of the fund is exempt from tax. So no tax while the fund is in place and growing. It's only at the point that we withdraw from the fund that we're still messing with. And this is the last part of the reform that government is dealing with. And they now have pegged 1 September 2024 as the date for implementation of this change. Good luck to the retirement fund industry to deal with this, but there is no question that our administration costs are going to go up, because this is what's going to happen from 1 September 2024. The balance in our fund, whatever it might be, on the 31st of August is going to vest. And that is going to be separated, and that pot is going to be dealt with in terms of our existing withdrawal rules. So you take a lump sum pre-retirement, you're taxed on the pre-retirement withdrawal tables. You take a lump sum post-retirement, you're taxed on the lump sum retirement tables. Straightforward, in place as we stand. So one pot put aside. The only change with that pot is they're going to take some seed capital to put into this new pot called the savings component. But that's limited, and it's a relatively small amount. So either 10% of the value on 31 August or 30,000 Rand. So maximum 30,000 Rand can be used as seed capital in this savings pot. Contributions then moving forward. Contributions post 1 September are going to be split. 1/3 will go into a savings pot and 2/3 into a retirement pot. The savings pot, you can make withdrawals ongoing. So during your employment, during the life of the fund, you can make withdrawals out of your savings pot, but limited to 1 a year, and that must be in excess of 2,000 Rand. So the idea here is that they're giving us access to some of our retirement funds, and the 2/3 component, the retirement pot, is being preserved for retirement. We cannot access that pot. If you do make a withdrawal from the savings pot, it will be taxed at your marginal tax rate. So no longer taxed, the withdrawal table, the lump sum withdrawal table applies. You're simply, that's added to your other taxable income and taxed at your marginal rate. And the post-retirement lump sum will, so that withdrawal will be taxed according to the lump sum tables, whether it comes out of the savings pot or the retirement pot. So some quite complex, significant changes coming through with effect from 1 September. So look out for those. Then moving on to corporates and business and the changes that have come through here. We've got an incentive that's going to come through 1 March 2026, and that is for the production of electric and hydrogen-powered vehicles. So manufacturers are going to be eligible for 150% deduction of qualifying investment spend. So that's quite significant, and certainly only a couple of players in that market, but that's something to look out for. And then you might say that this next one is fairly irrelevant, but it might affect more of us than we think. The global minimum corporate tax to be implemented, and that's the second pillar, or second part of the OECD BEPS project, and that's the base erosion and profit shifting initiative that the OECD has got countries to buy into, and South Africa is one of those. The impact is that multinationals with a turnover, a global turnover, in excess of 750 million euros are impacted by this initiative. Smaller entities not. And the idea is that those groups pay tax at an effective rate of at least 15% on a consolidated basis. So what that means is that South Africa's had to change, or going to have to change. It's certainly going to come into effect 1 Jan, but the law is going to have to come into effect to do that. And that is to introduce 2 new provisions. One is the income inclusion rule, and the other is the domestic minimum tax top-up rule, or legislation allowing for it. The income inclusion part is or that allows South Africa to collect a top-up from that South African component of the group if the effective tax rate in other countries is less than 15%. So if your tax havens continue to not tax those multinationals, the effective tax rate globally for that multinational is going to be less than 15%, potentially. And then there is a sharing amongst the countries that do tax of the top-up component. And the income inclusion allows South Africa to partake in the top-up. And the converse is that the domestic minimum top-up should apply, where the South African effective rate is less than 15%, we can top up to the 15% in South Africa. So watch out for that in the event that you are involved in any of those large multinationals. The next component, or the next change, is somewhat of a relief for me, certainly, because we make use of this, is the Section 12 Cap H learnership allowances have been extended to 31 March 2027. They were due to expire now, 1 March 2024. So that's a relief. Company income tax and assessed losses. Remember last year, and this is already in place in the law, years of assessment for companies ending on or after 1 April 2023, tax rate reduced from 28 to 27%. At the same time, there was a loss, a limitation to being able to offset taxable income against our assessed losses brought forward. And in essence, if our taxable income is below $1 million, we can offset the full loss. If it's above $1 million, we're still going to pay some tax and can't offset the full taxable income against the assessed loss. What we see is the proposal to give us some relief to this limitation in the event of a liquidation or deregistration of a company. So that's quite welcomed. And then the next proposal is something that's impacted me a couple of times, and I must say I will gladly accept this, is where we're dealing with foreign exchange losses. So we've got loans in or out of South Africa that result in exchange gains or losses, which are taxable or deductible or create a loss. The issue has always been that if you make a loss in 1 year and you're no longer trading in future years, that loss on that particular loan cannot be offset against a gain made in a future year if you're no longer trading, because you lose your assessed loss carried forward if you stop trading. And they're now proposing that that loss and gain is ring-fenced so that no matter whether you're trading or not, you don't lose it. So that's welcomed. And importantly, no change in the income tax rate, and that 27% still exists. A couple of changes on the VAT side, or proposals on the VAT side, which are noteworthy. The first is that, well, the first noteworthy one is the no change to the rate and the registration threshold. So that was somewhat welcomed on the rate because there were a couple of us a bit nervous. But registration threshold, sure, that R1 million has been in place for too long now, but it stays. Importantly, because I know that some of us play games with claiming our input credits, and we smooth those over a period of time, knowing that we've got 5 years in which to claim them. And we don't like getting refunds because we get audited, so we smooth our inputs over a period. Well, SARS are on top of us, and the proposal is to amend the 5-year period, and we have to now put the input back into the period to which it relates. And SARS tell us that'll make their auditing a lot easier. I'm mindful and terribly sorry, it's 9:30. I think I've got one more slide. And then what we've got is the last point here, where we know at the moment we can claim an input VAT when we write a bad debt off, but when we recover that bad debt, we don't need to pay output. That's going to change. So the proposal is to implement that. My last slide, and this has got nothing to do with the budget. It is just a reminder, because trusts are in for two significant changes this year. And that is the first one: any South African trust making a distribution to a non-resident beneficiary. We know that the capital gains tax rules catch that capital gain, tax it at the trust tax rates, and thereafter we can distribute the net amount to the non-resident beneficiary. So taxed at trust tax rates. Income has been different. That changes from 1 March 2024. Any distribution paid to a non-resident beneficiary from 1 March 2024 is now locked in the trust, taxed at the trust's tax rate of 45%. The net amount then can go to the beneficiary. Same treatment, capital gains and income. A significant change where you are sitting with non-resident beneficiaries that you've passed income through to in the past. Please take note of that. And then the other change around compliance comes in September this year. It relates to both taxable and non-taxable distributions made to any beneficiary. And we now have a program whereby the trust is going to have to produce an IT3T for every distribution to every beneficiary. And that IT3 will be populated on the e-filing site and submitted to SARS. So that deadline for the 2024 tax year, so year ended 29 Feb 2024, is 30 September 2024. So please, everyone, just be aware of that. And those deadlines are quite tight and onerous. So with that, I know I've run out of time. So thanks so much for bearing with me, and all the best for the rest of the day. Cheerio.